Welcome to another deep dive. Today we're cutting through the noise, really trying to understand what's shaping the future of the homeownership experience. And our focus, it's squarely on Rocket companies. We've pored over their latest second quarter 2025 earnings call and press release. And wow, they're absolutely packed with fascinating details, financials, some really bold market moves, and some surprising tech advancements.
Yeah, and what's really interesting here, I think, is that this isn't just about, looking at quarterly numbers. It's really about dissecting a strategic transformation. So our mission today is to unpack how Rocket is integrating these massive acquisitions, like Redfin, pushing the boundaries with artificial intelligence, and streamlining operations to fundamentally change how you, the listener, might buy, sell, or finance your next home. Get ready for some genuine aha moments as we go through this.
Okay, let's unpack this then, starting with the numbers. Despite what they themselves described as a tough housing market, Rocket companies deliver some genuinely impressive results in Q2 2025. What's the headline story here?
Well, the headline is really resilience, I'd say. They actually exceeded their own guidance. Adjusted revenue hit $1.34 billion, which is a real testament to their execution, especially when you think that the financials from that huge Redfin acquisition, well, they aren't even included in these Q2 results. That deal only closed July 1st, remember?
Right, good point. So this is pure Rocket performance pre-Redfin.
Exactly. And diving into the highlights, net rate lock volume increased 13% year over year to $28.4 billion. Closed loan origination volume hit $29.1 billion. That's an 18% jump compared to Q2 last year.
Okay, so solid volume growth.
Yeah, and client growth, too. Served over 100,000 origination clients, a 19% year-over-year increase. And home equity loans were a particularly strong driver. Get this, volume nearly doubled year-over-year.
Doubled, wow.
Yeah, hitting a new record for units and volume, and making up almost half of all their new home equity loan clients. They also reported adjusted EBITDA of $172 million, that's a 13% margin, and adjusted diluted EPS of 0.04 cents. Gain on sale margin, 2.80%.
That's a strong financial picture, definitely. Particularly given the market backdrop they described.
Yeah.
They mentioned a delayed spring home buying season, April being tough.
That's right. Volatility was the word. Tariffs, rate fluctuations, dropping consumer sentiment. It all hit in April.
And existing home sale figures reflected that too, right?
Yeah, June existing home sales were 2.7% lower than May, at an annualized pace of 3.9 million. That's like over 20% below pre-pandemic levels. They're calling it a new normal.
A new normal.
Yeah.
And affordability, that remains a huge issue for so many people, a significant hurdle.
It absolutely does. But, amidst that, we are seeing some signs of optimism, and Rocket's actions kind of reflect that. Consumer sentiment, it's recovered. Home price growth is actually slowing nationwide, dropped from 6.9% down to 3.4% year over year.
Okay, that's a noticeable slowdown.
It is. And what's more, prices are actually softening in 11 of the 50 largest U.S. metro areas. Inventory is expanding by double digits year over year, and affordability is slowly improving. These are all indicators that the market is maybe gently shifting back towards buyers.
And Rocket's response?
Proactive. Their affordability programs like One Plus and Rocket Rent Rewards, plus various seasonal promotions. Those supported their purchase volume growth month over month from April right through June. And refinance volume also saw strong growth, both quarter over quarter and year over year, especially when the 30-year mortgage rate briefly dipped to 6.6%.
So they jumped on that opportunity.
Exactly. It tells us that even in this quote-unquote new normal, there are still strategic opportunities for growth if you're nimble.
Okay, now here's where I think it gets really interesting. Rocket isn't just, talking about AI. They're implementing it in ways that seem to be transforming their entire business, from how their bankers work to the back-end operations, even how you, the client, interact with them. You mentioned infinite capacity earlier.
Right.
Can you break that down for us? How does AI truly create that? What does it mean for, the traditional limits of a human-driven business?
That's really the core question here, isn't it? How does AI translate into real improvements? Rocket is demonstrating it through boosting productivity, enhancing the client experience, and achieving what they call infinite capacity.
Yeah.
So for their bankers, right, they've developed an AI-powered communication platform. It handles dialing, texting, follow-ups, chat, basically automating a huge chunk of admin tasks.
Taking the busy work off their plates.
Exactly. And new enhancements dynamically prioritize client follow-up pipelines. They even offer AI-recommended next steps. And the result, a nearly 20% increase in daily refinance client follow-ups. This isn't just about saving time, though. It's about letting their human experts focus on the complex, the empathetic parts of the client relationship, while the AI handles the repetitive stuff.
Right, leveraging human talent more effectively.
But it's not just client-facing, you said. They're using AI in operations, too. How's that playing out behind the scenes?
Absolutely.
Oh,
Their agentic AI tool. It's revolutionizing underwriting. It breaks down complex manual processes into steps that AI agents can handle. It uses something called Model Context Protocol, MCP. Basically, it helps the AI understand and navigate all the different data sources within Rocket's vast ecosystem. Think of it like a super smart detective for underwriting.
okay, give me an example. Okay, a great example is reviewing earnest money deposits, EMDs. This used to be tedious manual work, checking documents, tracing funds by hand. Now, Agentech AI verifies documentation, traces funds automatically. It only flags exceptions for human underwriters to look at.
So it handles the bulk of it.
Right. This system now processes EMDs for over 80% of purchase agreements, and it's estimated to save operations nearly 20,000 hours annually, which, significantly speeds up the whole process for clients, reduces friction in what can be a really frustrating part of buying a home.
And that speed and smoothness extends directly to the client experience itself, for you, the home buyer.
Precisely. Take their AI-powered chat. Over 80% of clients now choose to continue applications through chat. And get this, over 10% of leads are arriving outside traditional business hours because the chat is always on.
That makes sense. Convenience.
Exactly. And what's truly remarkable is the conversion rate. Clients who start their journey in AI chat convert at 3 times higher rates for purchase applications and 2.5 times higher for refinance applications.
Oh, that's huge.
It is. And the chat also collects essential info, upfront, income, property, assets, credit, which streamlines qualification and makes the handoff to a human banker much smoother. They've also launched a fully digital refinance experience. Clients can complete a digital refi application to rate lock in under 30 minutes, entirely online, 2047.
Under 30 minutes.
And their audacious goal is to get it even faster, aiming for under 10 minutes. Like as simple as pressing a refi button on any mortgage they service.
A one-click refi almost.
That seems to be the vision. And the overall impact on capacity brings us back to that infinite capacity idea. Rocket managed daily volume spikes 2 to 3 times normal from seasonal promotions without adding a single team member.
Okay, that's the proof point right there.
Exactly. It shows AI's ability to flex and scale operations dramatically. Human capacity is no longer the absolute limiting factor. It means they can handle massive surges without missing a beat, or hiring and firing cyclically.
That's a massive strategic advantage, especially in a volatile market. Now, Rocket isn't just innovating from within, are they? They're expanding their footprint through major acquisitions. The Redfin deal closed July 1st. Mr. Cooper still on the horizon. How do these deals fit into their long-term vision?
Yeah, if we connect this to the bigger picture, these acquisitions are all about creating a seamless end-to-end homeownership platform, moving Rocket far beyond just mortgage origination into a full lifecycle approach.
Owning the whole journey.
Pretty much. The Redfin acquisition's strategic rationale is clear. Gives Rocket a massive new foothold in the home purchase market, expands their local presence, and maybe most importantly, provides direct access to 50 million monthly consumers right at the top of the funnel.
Where the search begins.
Exactly. This isn't just about getting more leads. It's about owning that entire customer journey. From the initial home search, which is where 90% of buyers start right through to closing. This gives Rocket an unprecedented integrated platform advantage over traditional lenders who only step in later.
And they moved fast on the integration, didn't they? What were the biggest hurdles there, bringing two big companies together so quickly?
They absolutely did move fast. Within the first month, they executed a comprehensive brand update. You saw Redfin, powered by Rocket co-branding, pop up on digital pages, and they introduced pre-qualification buttons on every single home listing on Redfin.
Smart. Catch them right there.
Right. The biggest hurdle is always blending cultures and systems, of course, but their speed suggests a very clear, focused integration plan. For clients, they launched Rocket Preferred Pricing on July 1st, offering qualified clients folks financing with Rocket Mortgage and working with a Redfin agent either a 1% rate reduction in their first year or up to $6,000 in closing credits.
Okay, incentivizing the synergy.
Definitely. They also expanded lending options, super jumbo loans, non-qualified mortgage products, extending these to Redfin clients, their own retail bankers and broker partners. Plus, they added nearly 150 Bay Equity loan officers to their retail force, and they're bringing the Rocket Homes and Redfin agent networks together for what they call synthetic scale, basically a bigger combined network.
That's a lot of movement in just the first month or so.
Yeah.
What about early results since July 1st? Are they seeing the promise play out?
The early results seem very promising, yeah, suggesting the synergies are materializing quickly. The very first Redfin client closed on a home in Colorado in just 10 days.
10 days, that's fast.
Very fast. Over 65 Redfin clients have already closed with Rocket Mortgage since July 1st. Nearly 200,000 people clicked Get Pre-Qualified within Redfin, shows significant interest. Of those with a Redfin account, 23% became contactable leads at Rocket. And 12% of all users entering that funnel went on to start an application.
So the funnel is working.
It seems to be. Plus, 7,000 agent referrals have been sent to Rocket Mortgage, and clients referred from Rocket to Redfin. They're 30% more likely to upgrade to verified approval letters, VALs, which is a strong indicator of conversion intent, serious buyers. They anticipate $200 million in total synergies from this deal, $140 million expense. $60 million revenue. And those early revenue signs are definitely encouraging.
Okay, switching gears slightly to Mr. Cooper, that deal is still in the works, correct? How does that acquisition fit into this expanding ecosystem?
That's right, still pending. The Mr. Cooper acquisition is strategically critical because it supercharges Rocket's industry-leading recapture flywheel. Think of it like a loyalty program for your mortgage, basically.
Okay.
Once you're a Rocket client, they make it incredibly easy and attractive for you to come back for your next loan. That's why they have such a powerful recapture flywheel effect. This is essential for purchase growth, and it significantly helps reduce their client acquisition costs over the long term, getting repeat business.
Makes sense. And the status of that deal?
They're on track for a Q4 close, they say. They've received HSR approval, that's the antitrust clearance from the government, and they're advancing with state-level regulators, the GSEs, Fannie Mae, Freddie Mac, and their regulator, the FHFA. They also said conviction on the synergy numbers for this deal continues to increase.
Okay. And what about their capital position? With these huge acquisitions, how are they funding all this? Seems like a lot of cash needed.
They have a very strong capital position, actually. As of June 30th, they held $6 billion in available cash, plus $7.6 billion in mortgage servicing rights, MSRs. That totals $13.6 billion in balance sheet value. Their total liquidity stood at $9.1 million, so quite a bit of firepower.
Okay. And the Mr. Cooper funding specifically?
To fund that, Rocket successfully issued $4 billion in unsecured bonds back in June. This was specifically to refinance Mr. Cooper's existing debt. Essentially, they borrowed money from investors to pay off Mr. Cooper's loans, and that offering was nearly 3 times oversubscribed, which signals really strong investor confidence.
So the market believes in the deal.
It seems so. And importantly, this debt gets extinguished if the Mr. Cooper transaction for some reason doesn't close. So it's tied to the deal happening.
Got it. Now, MSR is mortgage servicing rights. What's their strategy for hedging those? Especially given the new Mr. Cooper portfolio will be so large, hedging can be complex.
Yeah, it's a good question. Rocket historically hasn't fully hedged its own MSRs, partly because their high recapture rates acted as a sort of natural hedge. If rates went down, sure, the MSR value dropped, but they recaptured the client with a new loan. It was a strategic choice.
But Mr. Cooper's portfolio is much bigger.
Exactly. So the plan for Mr. Cooper's significantly larger portfolio is to continue hedging. They're targeting 60-70% coverage while they prove out the recapture synergies on this new larger scale. They also layered on a specific hedge during Q2 to preserve float earnings on lower note rates, shows dynamic management there. And the combined entities will also have a competitive bid process for buying new MSRs, letting them be opportunistic and stick to high expected return thresholds, basically be more selective about what servicing they acquire going forward.
Okay, so we've seen how Rocket is growing through these big acquisitions and innovating rapidly with AI. But growth isn't just about adding new pieces, is it? It's also about sharpening the existing ones. And it looks like Rocket has been making some tough calls there to drive efficiency. What kind of operational streamlining are they doing?
Yeah, this reflects a very disciplined approach to expense management, making sure resources are focused effectively towards that core mission of homeownership. They completed the shutdown of Rocket Mortgage Canada back in Q2. They initiated the wind down of the Rocket Visa Signature Card program in July.
Okay, shedding non-core assets.
Right. And they also restructured their general and administrative or G&A teams supporting the mortgage origination business in July. And they explicitly said this was a direct result of their AI and automation investments. It reduced redundant roles and helped retire legacy workflows. So it's not just about cutting fat, it's really about re-engineering their internal processes for this new AI era.
So these streamlining efforts, they're expected to save a significant amount. What's the impact of focusing operations like this?
Yes, these actions are expected to collectively deliver about $80 million in annualized savings. And importantly, this is separate from the Redfin and Mr. Cooper synergies, with the majority of these savings expected to be realized in Q4. The primary objective, they stressed, of these wind downs and restructurings is to sharpen their focus on that integrated homeownership platform, making sure every part of the business aligns with that grand vision, even if it means stepping away from maybe slightly unprofitable ventures to reallocate those resources to higher impact areas. It speaks to a very clear strategy.
Very focused. Okay, looking ahead then to Q3 2025. What's Rocket's outlook for the market and for their own performance?
Well, they're cautiously optimistic for an extended summer home buying season. As the market continues that slow shift in favor of buyers we talked about, their approval letters indicate strong activity continuing right through Q3, which kind of bucks the typical seasonal slowdowns.
Okay, so maybe a longer season this year.
Maybe. Their adjusted revenue guidance for Q3, which now includes Redfin, is expected to be between $1.60 billion and $1.75 billion. If you look at it on a Rocket standalone basis, just to compare apples to apples pre-Redfin, that translates to a 6% year-over-year and 4% quarter-over-quarter increase, which is actually quite strong compared to the flat MBA forecasts for the broader market.
So they expect to outperform the market again.
That's the guidance. Consolidated expenses are projected to increase by about $335 million compared to Q2, but that's primarily driven by adding Redfin's costs, about $275 million, and about $90 million in non-recurring items, things like transaction costs, severance, interest from that Mr. Cooper debt refinancing. This is partially offset by a $30 million reduction in Rocket Mortgage marketing spend as some brand restaging costs roll off.
Got it. One last point, they mentioned the Up-C collapse. What was that about?
Ah, right. Rocket completed the simplification of its capital and organizational structure on June 30th. It's often called an Up-C collapse in the finance world. It's basically a corporate streamlining move. Makes their structure clearer, more investor-friendly, and importantly, more nimble, particularly for future acquisitions like Mr. Cooper, by making their common stock easier to use as currency in deals.
Okay, makes sense. So, wrapping this all up, what does this all mean for you, the listener, the learner, the homeowner, or the future homeowner? Rocket Companies isn't just adapting to a new normal in the housing market. It feels like they are actively trying to shape it. With strategic acquisitions like Redfin and Mr. Cooper and this really aggressive embrace of AI, they're building something that can feel completely different than the homeownership journey of the past. It feels like a fundamental rewrite.
It really does. And this raises, I think, an important question to leave people with. Considering the sheer scale of Rocket Company's data now, especially with Redfin, their AI ambitions, their push for infinite capacity, how might a future homeownership experience become truly personalized and predictive, like anticipating your needs before you even know them, buying, selling, refinancing? And what would that mean for the traditional real estate and mortgage industry as we know it, when one company can potentially offer such a comprehensive, seamless, and proactive service from start to finish? Something to mull over until our next deep dive.